I'm here in the most competitive lunch market in the world, New York City. Within a minute walk from here, there are a dozen different restaurants trying to sell you a bowl. I'm here for this one, Sweetgreen. I've been a big fan for years, but recently if you read the headlines, you think the company is in trouble. Traffic is down, the fast casual hype is fading, Wall Street thinks the brand is done. I think they're wrong. I didn't want to just speculate, so I reached out to the CEO of Sweetgreen, and he actually responded. He set me up with their head of investor relations so I could ask the tough questions. I learned everything in my research, from the company's strategy to how the bowls are styled. So come with me on this journey and we'll learn everything about the company behind the bowl. A year ago, Sweetgreen seemed to be on the cusp of becoming a future blue-chip health brand. But this year, consumer stocks are on a decline, and they've seen a big drop in traffic across all the fast casual restaurants, and some are even calling it the Slop Bowl Recession. But is Sweetgreen really slop? It doesn't have slop attributes the way I see it. I've never had a scoop of bean juice. I asked Rebecca Nounou, head of investor relations, what she thinks about all this.
The word slop bowl, I think, really does actually a disservice to the product that Sweetgreen does. And I totally get that as clickbait, but I just want a moment to sort of say, I think it does a disservice to the Sweetgreen product and to our farmers who we source from across the country. Farms like Rio Fresh and Courtney, who wakes up every morning to tend for her kale, or the Freitas family farms, which is a fourth generation farm who've been growing cauliflower for decades. And so these are all ingredients that are sourced with care for the land.
I'll continue to share the rest of the Q&A with Rebecca. In the rest of this video, we'll talk about the product, the tech, the macro, the financials, and finally, the meme potential. Of course, Rebecca works for Sweetgreen, so she should say the food's great. To stress test this, I wanted to talk to someone who has no skin in the game and whose job is literally to make sure food looks good on camera. I sat down with local New York City food stylist Eliza Crane. So a couple of weeks ago, I stumbled in this bar in my neighborhood and met Eliza here. She is a food stylist and recipe developer. I'm just a guy, so the extent of my knowledge is put the rice on the bottom and the meat on top, and that's also my recipe. But I thought what you're doing is really interesting, and I wanted to hear more about what it is that you do. What is food styling? What's recipe development? And why is it so important for the food industry?
Food styling is essentially making sure that food looks great in photos. And there's all sorts of different tips and tricks. So anytime you get a cookbook, anytime you see a recipe on the New York Times or Bon Appetit, anytime you're watching a McDonald's commercial, there's a food stylist behind it, making sure that the food looks good. And some of that is just about color and composition and gloss.
What's your first impression when you look at it? How is it styled? Do you like the presentation? What are your thoughts?
I mean, I think it's nice that they focus on a lot of different like colors and textures, right? So it does look pretty visually appealing. You have the creaminess of, I don't know, is that ricotta or chèvre? And the apple, and you have the greens, and you have the rice, and on mine you have like the pops of green from the avocado and the cucumber, and you have, you know, for both flavor and texture, your pickled red onion to freshen things up. I mean, I was noticing like the nori and crispy condiment was kind of on the bottom underneath the dressing, which was then plopped on top in the middle so it wouldn't move. Whereas usually if I were styling, that would have been gently sprinkled over the top.
That's a really interesting observation. How do you feel about the overall recipe?
I think they do a good job. The salmon itself has a nice little bit of like crispiness to it. It has some flavor. The miso dressing is very punchy and quite thick, so you get a lot of flavor in the bite. But yeah, I think the dressing does a lot for the bowl and like really bringing the flavor. And the pickled onion as well, which is one of my favorite things. Any sort of like pickled condiment is a great way to level up your bowl and add color and acidity.
In any case, I wanted to better understand customer concerns. So I did some research and I brought this up with Rebecca. I did a deep dive on the Google reviews of all 260 restaurants that you guys
Uh-huh.
have, and also with some of your competitors. And a pattern that I noticed is people who give low reviews to not just to Sweetgreen, but to anyone, it's usually some complaint about portion sizing or something related to the operations. This looks pretty bad. So what is Sweetgreen doing about it? Well, I think one of the things they are doing is installing what they call the infinite kitchen across their stores. These automated machines dispense each ingredient, measuring the precise weight, and they can build 500 meals an hour.
Hmm.
And so when I put that in the context of what you guys are trying to do with the infinite kitchen, that makes a lot of sense because you're portioning it exactly by the right amount of weight, and you're not going to have that variability where sometimes somebody gets a little bit less of something, and that can be very
It's
upsetting.
human error, yeah, more than
Yeah.
intentional. I will say we have seen our complaints come down significantly, and consumer satisfaction go up with the result of the portion changes that we made to our chicken and tofu by increasing them 25%. So we've seen those complaints come down.
So sourcing and operations are better off, but what about hospitality? I asked Rebecca if robots kill the vibe.
The infinite kitchen doesn't remove the hospitality, it actually allows you to give hospitality. I think so much of when you're rushing down a front line or you're behind in a production, you don't get a chance to look up and say what to put in the bowls. We make sure that as part of a handoff, we hand off a bowl to a customer. And we've actually used some of the labor savings to deploy a role around hospitality, particularly at the kiosk, should they wish to order there and not on their phone. So it starts with human hands and ends in human hands.
Overall, I'm really excited for Sweetgreen and their use of the Infinite Kitchen. It should provide a more consistent experience and it's highly scalable. I think this is definitely key to success for them in this industry. There's another angle to the Infinite Kitchen I want to make. There's this term called economic complexity, which economists use to describe why some companies become rich. And what they found is it's not just about a company's ability to process raw inputs into a premium product, but it's also about their ability to develop and build tools to help them do things more effectively. There's one company out there that's not Sweetgreen that also started off harvesting plants and trees and is now a giant tech company. You'll never guess which company it is. That company is Nokia. Let me explain. Nokia's journey began in 1865 as a humble paper mill in Finland. Its primary business was harvesting and processing timber, a simple resource extraction model. Instead of just cutting trees, Nokia began to develop tools to help it cut trees more quickly. Nokia was then able to use those tools to expand into the rubber industry, producing everything from tires to boots. Finally, their expertise in manufacturing allowed them to pivot to telecommunications. In each of these pivots, the company developed economic complexity and transformed from a paper mill into a global leader in mobile technology. Thanks, Gemini, for the graphics. I think Sweetgreen's willingness to lean into tech via automation and their digital platform speaks to how they're trying to develop economic complexity in the same way as Nokia. The stock market thinks Sweetgreen is just a salad company, which is almost like saying Tesla is just a car company. Short sellers better watch out. Today, the rage in tech is AI, so I asked Rebecca how Sweetgreen is using it. This wouldn't be an interview with the head of investor relations in 2025 if I didn't talk about AI.
Yeah.
So
We use AI from hiring to labor deployment. We use AI around forecasting, demand planning, better ordering. AI to me is a tool to help get the best out of our teams and to help us move faster, but not necessarily a replacement. And so we're really using it as, how do we enhance for better decision making, better speed and better agility? And we are looking at how AI can continue to deploy and enhance the consumer experience in terms of predictive ordering, what flavors go with what, how do we recommend? We are working through a new kind of create your own journey flow in our app. And so a lot of that that will help you and sort of say, if you select these, here are the right three pairings to go with it, kind of both from an ingredient level and sort of toppings to then dressings. And we will start to get smarter about it, but we deploy AI in terms of CRM, knowing what cohort you're in, what offers to push, and the machine's going to get smarter and smarter to offer you the right things that get you kind of coming back. I would say we're at the early innings of deploying AI, and we will continue to leverage it really to help us make smarter, faster decisions.
To understand the stock, we have to understand the world that it lives in. And right now, that world looks grim. We're in late 2025, and consumer sentiment is at historic lows. I'd argue that this is being driven by two things: politics and a K-shaped economy. First, on politics. You can see in this chart that the consumer sentiment has dropped sharply ever since the new president was elected. This is driven by his policy changes and his blitzkrieg tariffs. You'll also see how the share price of fast casual has followed the sentiment index here. But politics is cyclical. We're already seeing signs of moderation, such as the administration recently lowering the tariffs on beef. As consumers feel economic pain, the administration will be forced to push and pull different levers to try to fix the situation. The second factor is stickier, the AI disruption. It's creating a bigger divide between the haves and the have-nots. I asked Rebecca if they're seeing this K-shaped squeeze in their data.
What we've really seen is a broader macro decline, whether it be coastal, whether it's Los Angeles or the Northeast. 60% of our comp revenue comes from those centers. I mean, it's just a matter of our densification of our footprint vis-a-vis other players.
She was surprisingly upfront about who is leaving.
The 25 to 35-year-old age cohort is sort of trading out of the category. They make up about a third of our customer base, and we're working on getting them back into the fold.
So if young people are trading down to cheaper options, how do you win them back?
I would say certainly on the price, when you look at the pricing options, we do have different pricings across the country and in market, and our pricing varies across the menu. And so there are prices at $13 and $14. And, there are the protein plates, the miso salmon plate, which is a little bit on the higher end. And when we look at our competitors, we're not that far off. And particularly given the quality of product, antibiotic free proteins, grass-fed steak, and everything being prepared in our restaurant. And so we do need to do a better job of communicating that and letting folks know that, it's clean eating when you come to Sweetgreen.
And that clean eating point is where I think Wall Street has it all wrong. They're only thinking about the economic macro, they're ignoring the health macro. We are living in the longevity boom. This is the age of Brian Johnson, where people are obsessed with Oura rings, Whoops, tracking their sleep score, and especially their diet. Health is becoming a huge part of what we value in our society. In economics, there's also something called the lipstick effect. In recessions, consumers still buy affordable luxuries to feel good. People have been ripping on millennials for years for buying avocado toast. That's a good example of this. You may not be able to afford a home, but you can still afford to eat fresh food. And let's face it, for the kind of nutrition that you get, $15 is not that much to spend these days compared to your alternatives. Finally, we have the Federal Reserve. They've been cutting interest rates even though inflation is still running high. What that means is if inflation is above target, you want to hold real assets like stocks. And if they're cutting interest rates, they're stimulating the economy. As they continue to do that, people should stop trading down to cheaper options and trading back up to the healthy, fresh food that they really want. And that trading up is the dominant trend of our generation. Just as consumers moved from Nike to Lululemon, people are sick of eating Cisco truck food and they would much rather have fresh farm table food. Sweetgreen is one of the only players able to provide local farm ingredients at scale, but still within a price point that's affordable for everyday professionals. So just remember, economic gloom is temporary, but the demand for health, fresh food is timeless. So when I look at Sweetgreen, I'm not asking, can they survive a recession? I'm asking, who is going to benefit from the big trends in our society? Next, let's look at their finances. Sweetgreen trades at a fraction compared to their peers. Sweetgreen hasn't been profitable, but they've still been growing revenue and store count at a really impressive pace, And while their net income margins are playing from behind, they've been catching up favorably. I wanted to better understand what it will take for Sweetgreen to become profitable, so first I turned to their income statement to better understand their margins. Some areas definitely need improvement. I asked Sweetgreen what's their plan to achieve profitability.
We had 20% margins last year, so we know that we can get back to that, and we're really focused on driving the margin back up. Part of it is finding saves. There is some sales leverage that we need to drive, and we're going to do that with our pipeline of menu innovation this year, which is going to be greater than it was in any previous years.
I then compared these numbers to the current leader in fast casual, Chipotle. I wanted to see if her story makes sense. Starting from the top, on food, beverage, and packaging, I expect Sweetgreen to come down a little bit there. Because they offer a premium product, they should be able to have higher pricing power. On labor, we already know that the Infinite Kitchen should give them a structural advantage to Chipotle, and it's been said that it can improve margins by at least 7%. Occupancy costs should structurally be higher than Chipotle because they operate in more premium markets, which means more expensive real estate. But as they expand into the suburbs, I do think it will come down a little bit over time. So their restaurant level margins can definitely get to a level comparable to peers. And they've reported that their Naperville location, which had the first Infinite Kitchen, achieved margins at or above 30%. On general and administrative, this one definitely needs to come down a lot. I think they're making the right steps. The sale of Spice technology to Wonder actually reduces it by 3% right away because they've shifted, I think, 38 engineers off of their payroll. They also need to lower their depreciation and amortization costs, and that should come down over time as the stores age. Bottom line, I think their operating margin can definitely get to a level comparable to peers. In the meantime, while Sweetgreen improves their margins, they're still burning cash, so I took a look at their balance sheet to understand how much runway they have. It looks like they currently have about $130 million in cash, and that's enough to get them through 2026. But they also sold Spice to Wonder for $100 million in cash plus equity, so that brings the total to about $230 million. That's enough to get them through at least the next 2 to 2.5 years. I asked Sweetgreen how they are thinking about capital expenditures.
Well, first of all, I would say back on the Wonder deal, one of the things that we're really excited about is we still get access to the Infinite Kitchens, and Wonder is going to really take what we got to the commercialization level. How do they continue to expand on the technology and the capabilities of the Infinite Kitchen and help drive down the cost with their scale? So we'd like to see over time that $500,000 per Infinite Kitchen come down with even greater technology. So really excited to see kind of over the next couple of years how the IK evolves from both a capability perspective and a cost perspective. In terms of capital allocation, we have announced that we are reducing our store count for next year. So we'll be opening somewhere between 15 to 20 net NROs as part of preserving our capital and being really diligent in terms of ROIC and making sure that every dollar we spend has the best return. We don't think that by doing so and cutting the pipeline, we are impacting our TAM. We still think that there's plenty of communities that want Sweetgreen. We're just being judicious in terms of deploying capital. I think for us, where on the block matters. And it's not just about being in the right community, it's about having the right real estate, and you have to have A+ real estate and you can't settle for less. And whether it's in a place like LA, you need to find good parking, and every kind of market's a little bit different in terms of how the consumer kind of interacts with the flow. Where do you want to be in the mall? And in some markets, it's you want to be on the outside, and some you want to be inside. There's no one single almost rule for real estate, except for A+ real estate is A+ real estate. And we're very lucky as a brand to have landlords who want us as a tenant. And I go on these tours a lot, and everybody would love to have Sweetgreen. So for us, it's about actually choosing and prioritizing. And I think we're doing a really great job of that coming into 2026.
Finally, let's talk about the meme potential. The stock market is a strange place, but sometimes it's the simplest things that trigger a run. Take a look at this ownership split of Sweetgreen versus other companies that have had big runs in the past. 95% of the shares are held by institutions and insiders. Those aren't trading on a daily basis, so the last 5%, retail investors like myself, hold most of the supply. 25% of the share float is short. This could be catastrophic for shorts if demand comes in. Finally, the name is pretty awesome. It's literally called Sweetgreen. This stock has so much meme potential. If you know, you know. In conclusion, I believe the market is mispricing the stock. I see a valuation comparable to peers and a path to get there. And if the whole sector recovers, which I think it will because of the trends in our society, then this could run even higher. At that point, holding a bag of Sweetgreen will take on a whole new meaning.